The current landscape of the commercial real estate market in the United States is presenting a series of challenges that warrant careful analysis and consideration. Delinquencies on commercial real estate loans held by U.S. banks are on a steady rise, with over $900 billion of debt on commercial and multifamily real estate requiring refinancing this year. This, coupled with uncertainties surrounding the Federal Reserve's approach to interest rates, has created an environment ripe for scrutiny. As of the latest inflation figures, the Federal Reserve is expected to maintain current interest rates, potentially keeping them higher for an extended period. While there is speculation about a rate cut in June, the decision remains uncertain. The implications of such a decision, or lack thereof, could have a significant impact on an already complex economic scenario. One of the primary concerns arising from these circumstances is the potential for a major credit event. The January Consumer Price Index (CPI) report indicates an increase in inflation, setting the stage for a possible credit crisis. The confluence of rising inflation, dropping commercial property values, and an uptick in bad loans creates a precarious situation that demands attention. Of particular note is the exposure of small to mid-size banks, which hold approximately 70% of all commercial real estate loans. Marathon Asset Management's warning of an 8 to 10% default rate in the commercial real estate loan portfolios of these banks raises red flags. The vulnerability of these institutions is further underscored by research suggesting that a 10% default rate could result in approximately $80 billion in additional bank losses. Commercial real estate distress is not an isolated concern, it has the potential to render more than 300 smaller regional banks insolvent. The sector's susceptibility is exacerbated by market-to-market value issues, with an additional 231 banks facing potential challenges due to a $2 trillion decline in asset values following the 2022 monetary tightening. Bad commercial real estate loans have become a pressing issue for major U.S. banks, overtaking loss reserves. Delinquent commercial property debt for the six largest banks nearly tripled to $9.3 billion in the past year. This trend not only threatens the financial stability of these institutions but also raises questions about the adequacy of existing risk management practices. Global contagion fears add another layer of complexity to the situation. Asset managers worldwide are advising caution and advocating for limiting exposure to U.S. commercial real estate portfolios. In Germany, Deutsche Bank is reportedly preparing for what is described as the most significant property upheaval since the 2008 financial crisis. This acknowledgement underscores the interconnectedness of the global financial system and the potential for ripple effects across borders. Looking ahead, interest rate cuts, anticipated in June, could increase stress on banks grappling with a growing number of delinquent loans. Hybrid work arrangements, expected to persist, may keep vacancies high, further impacting property valuations and cash flow. The Federal Reserve's role in collaborating closely with system banks becomes crucial in mitigating risks and preventing the worst-case scenario from unfolding. A comprehensive analysis of the situation necessitates a closer examination of the market-to-market value concerns. The decline in bank asset values following the 2022 monetary tightening has left 231 additional banks facing potential issues in this regard. This development underscores the vulnerability of banks to market fluctuations and the importance of adapting risk management strategies to navigate volatile economic conditions. The illustration of the commercial real estate coverage ratio provides a visual comparison of 2022 versus 2023 loan reserves to delinquent loans at the biggest U.S. banks. This visual representation reveals a concerning situation, emphasizing the urgency for proactive measures to address the challenges at hand. In conclusion, the current state of commercial real estate and its implications on the banking sector requires a meticulous and proactive approach. The intersection of increasing loan delinquencies, uncertainties in interest rate policies, inflationary pressures, and global contagion fears creates a complex economic landscape. The Federal Reserve's collaboration with system banks, prudent risk management practices, and a strategic reassessment of loan portfolios are imperative to mitigate risks and pave the way for a more stable and resilient financial system. As we navigate these challenges, a realistic and comprehensive understanding of the economic dynamics at play will be paramount in shaping effective policy responses and safeguarding the financial well-being of institutions and economies alike. Please go ahead liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.